The Bank of Japan is at a pivotal moment. Market expectations for a 25 basis point interest rate hike in June have skyrocketed to an astonishing 79%. Stick around until the end of this video, and you'll see why this policy shift is almost a done deal and what colossal risks it poses to your investment portfolio. Remember, the last time the BOJ made a move, stocks plummeted by 10%. Are we bracing for another downturn? So, what's driving this sudden shift? For years, Japan has kept its monetary policy extremely loose, but the pressure to change is becoming overwhelming. Rising Japanese government bond yields are complicating the BOJ's plans to slow down its bond buying. The central bank finds itself in a bind, balancing the need to support the yen against the risk of upsetting the bond market. This situation is not just a local concern, it's a clear indicator of significant changes in global liquidity trends. Let's dive into the facts. The BOJ's current policy rate sits at 0.75%. Despite some swirling rumors on social media, Governor Kazuo Ueda has not made any emergency statements today, and the rumored massive $620 billion stock sale remains unverified. However, the market isn't waiting for confirmation. Rising JGB yields are tightening financial conditions, making it increasingly tough for the BOJ to keep its bond buying pace without risking even higher yields. On social media, the mood is one of heightened caution. Traders are noting that the 79% likelihood of a hike introduces a policy surprise risk. The sentiment is unmistakable. If the hike occurs, a sell-off in equities could follow. Investors are recalling the previous hike that sent the Nikkei down by 10%. Some posts caution that the rumors of an emergency statement might be an attempt to spark unnecessary volatility in the yen, urging traders to rely on credible sources in these turbulent times. Analysts are now zeroing in on the yield headwinds. Rising yields can be a double-edged sword. While they indicate a move towards normalization, they also threaten to disrupt the BOJ's plans to taper bond purchases smoothly. There's a growing concern that increasing bond yields could tighten financial conditions too rapidly, compelling the BOJ to adopt a more conservative stance on future hikes. The adjustments in bond holdings by commercial banks are also a crucial factor experts are monitoring, as they significantly impact economic momentum. For the Nikkei 225, the stakes are extraordinarily high. A 10% drop is being discussed as a very real possibility if a hike occurs. Commercial banks are already adjusting their holdings in response to yield pressures, creating a feedback loop that guides market expectations. If the BOJ acts too decisively, corporate earnings may suffer due to increased borrowing costs, particularly in sectors burdened with debt. Investors need to brace for heightened sensitivity to every word from the BOJ in the coming weeks. In the foreign exchange market, the US dollar to Japanese yen pair is drawing significant attention. While typically a hike would strengthen the yen, the current yield pressure may actually keep the pair stable for longer, especially if the BOJ's normalization is seen as being forced by market conditions rather than economic strength. Additionally, how Japanese yields influence global rates is a pressing concern. Any instability in the JGB market could send ripples through global bond markets, impacting everything from US Treasuries to European yields. So, what steps should you take? First, distinguish between signal and noise. No emergency statement has been confirmed, so resist the urge to react impulsively to unverified social media posts. Next, keep a close eye on JGB yields. They serve as the primary indicator for BOJ policy changes. Finally, manage your risk exposure to the Nikkei. If that 79% probability becomes reality, prepare for a wave of volatility. This is a crucial moment for risk management and monitoring yield thresholds, rather than chasing speculative opportunities. Based on the current data, we identify three potential scenarios. The base scenario predicts a 25 BP hike in June, with the BOJ managing market expectations successfully, leading to moderate volatility. The bear scenario, which is the most concerning, anticipates a 10% drop in the Nikkei as a rate hike triggers a rapid tightening of financial conditions and capital outflows. In contrast, the bull scenario envisions the BOJ holding steady or raising rates with very dovish guidance, allowing the yen to stabilize without hampering equity momentum. The key factor will be the BOJ's ability to maintain order in the bond market. To sum it all up, the market is eyeing a 79% chance of a June hike, JGB yields are under immense pressure, and the risk of a 10% drop in the Nikkei looms large. What do you think? Will the BOJ go through with a 25 basis point hike, or will they hesitate? Share your thoughts in the comments below. And don't forget to subscribe to Tokyo Macro for more in-depth explorations of the Japanese economy. We'll see you in the next video.